Chapter 14 review. We're going to go through some problems that we did in Chapter 14 so you're ready for your test. Okay, so we're going to use this as our example. It says, Evan Corporation completed the following transaction related to uncollectible accounts receivable during December of the current year. And in this problem, we're not going to do the posting, but I know you know how to post. Okay, so our first directions is to journalize the following transactions completed during December of the current year. Use page 14 of the general journal and 16 of the cash receipts. And so we're going to go through these problems right here. All right, so our first one is December 6th, wrote off Fisher Corporation past due accounts as uncollectible. So what I would like you to do is to fill out your sheet. When you are done, then go through my explanation. So you need to pause it and fill out the transaction into your journal. All right, so the first transaction, you are going to use your general journal. Okay, so you should have written in the date, December 6th. I should have probably used a little darker pen, but I think you can see it. Remember, we are writing off account as uncollectible. So our allowance for uncollectible accounts will be debited for $2,410.16. Our accounts receivable, Fisher Corporation, will be credited for the same amount. And we'd use document 122. We draw the diagonal line because we would be posting in two spots. Okay, we're going to do the same thing with each transaction. So once I read the transaction, you should pause it, and then you should do yours and compare it to what I have. Second one, accepted a 90-day 8% note from Jordan Company for an extension of time on its account. Okay, so again, we're going to go to our general journal, and you'll fill that out. So pause now, fill it out. Okay, what you should have had is on the 10th, we are going to debit notes receivable for the amount of the note, $6,300. And we will be crediting accounts receivable, Jordan Company, for the same amount. Remember, we are transferring it out of a receivable into our notes receivable. Diagonal line. And our notes receivable, number 12, is our document number. The third transaction, received cash from Stanton Associates for the maturity value of notes receivable 6, a 120-day 8% note of $3,000, receipt right there. Okay, so we're receiving cash, so we have to go to our cash receipts, so go through and fill that out, and then check my answers. Okay, what you should have done is the date is December 14th. Notes receivable for the amount of the note, which is $3,000. Then we are going to be collecting interest income on that note. So the principal is $3,000 times the interest of 8% times 120 over 360 days, and we'll come up with an interest of $80. Okay, so our interest income, remember that is a revenue, so we will credit that for $80. The amount of cash that we're going to claim or we're going to get is the maturity value, and that is $3,000 plus 80 is $3,080. And our document number is receipt 289. Okay, our next transaction, Lane Company dishonored note receivable 8, a 90-day 6% note for $4,000. And it's written on M125. So again, fill this out, pause it. When you are done, check my answers. All right, you should have went to your general journal. The date is the 20th. We have accounts receivable, Lane Company. We have notes receivable, and we have our interest income. So again, once they dishonor the note, it has to go back into the accounts receivable. So the amount of the note, it says in your problem that it is $4,000. So notes receivable has to be credited for $4,000. Okay, again, to figure out your interest, we need to take the principal times the rate times, it's a 90-day note out of 360 days in a year, and we'll come up with $60 interest. So that will be our interest income, and that will be credited because our income is going up, which is a credit. The amount that Lane Company owes us is the $4,000 principal plus the $60 interest. So the amount they owe us is $4,060. So again, once they dishonor a note, it has to go out of the notes and back into the accounts receivable. Memorandum 125 for the document, and we would draw a diagonal line because we will be posting two things from that line. Okay, our next transaction. Okay, we received cash in full payment of Fisher Corporation's account previously written off as uncollectible. Remember, when we have this, we have two different transactions that we have to deal with. First of all, we have to reopen the account, and second, we'll accept the payment. So go through and record those two transactions and then check my answers. All right, to reopen the account, it's the 28th. We need to go accounts receivable, Fisher Corporation. And the amount that belongs in his account is $2,410.16. And we're going to credit allowance for uncollectible accounts because now we realize this is a true value. And remember, our allowance for uncollectible accounts is just an estimate. And it is Memorandum 128. Then we're going to record receiving the cash. It's the 28th. We have a cash debit. We have an accounts receivable credit. And the name of the customer is Fisher Corporation. And it's receipt 301. So those are the transactions that are on that page. Don't worry about this. Ignore that part. All right, we're going to go to the next page. It says the aging of accounts receivable is listed below. by age categories. And what you're going to do is you're going to figure out the amount that's uncollectible and then record the adjusting entry. Okay, so to start with, we're going to take our amount times the percent to get to the uncollectible account. So go through and figure out all of those and then double check your answers with mine. So your answer should look like this. When you add them up, that's what you get. Okay, right now you have to make the adjustment. This is the amount that's uncollectible for this fiscal period. We already have this balance in our uncollectible account, so we have to adjust it for the difference in the amount. So we'll take $9,296.24 minus $1,530, and we come up with $7,766.24. And that is the amount we will use for our adjustment. Okay, to make the adjustment, we write the words adjusting entries because there is no source document. This is just a regular occurrence at the end of the fiscal period that we make adjustments. The date is December 31st. Remember, when we start our adjusting entries, we start on a brand new page. We write our uncollectible accounts expense. And I wrote that in the wrong number here. Here we go. Okay, so we have uncollectible accounts expense is $7,766.24. Our allowance for uncollectible accounts is for the same amount, a credit of $7,766.24. So that's how you work with the adjusting entry. The last thing we did, and we didn't necessarily do these in the same order, but we went through and we figured out the maturity value and the maturity dates. Okay, so the first one, we're going to take a look at the big table. You can see that notes receivable right now was created January 12th. So we're going to go through and figure out the maturity date. So January 12th through the 30th is 18 days. 90 minus 18 is 72 left. Then we have February, 28 days. 72 minus 28 is 44. March, 31 days. 44 minus 31 is 13. And then we have April, 13 days, down to 0. So for this one, our maturity date is April 13th. The interest, remember, we need to take your principal times your rate times the time, and you come up with $37.50. The maturity value then is your principal plus your interest, and that equals $2,037.50. Okay, the next note, June 5th for 180 days. So we have June 5th through the 30th is 25 days. 180 minus 25 is 155. Then we have July has 31 days. 155 minus 31 is 24. August, 31 days, and we have 93 days. September, 30 days. 93 minus 30 is 63. October, 31 days. 63 minus 31 is 32. November, there's 30 days. 2 days left, and I ran out of table, but December to 0. So the maturity date would be December 2nd. Figuring out the interest is your principal times your rate times your time, and you'll come up with $540. Your maturity value is $12,000 plus 540 comes up with $12,540.